the pattern is staggering, how we're following that pattern. And if this is correct, it means we're in the early stages of entering a bubble. And Justin, what I can tell you is when people are like questioning whether or not you're in a bubble, it means you're not in a bubble. Markets don't die on skepticism. They die on euphoria. So that also gives me very high confidence that we still have a lot of room in the secular bull market. These are profound technologies all happening at the same time. And when you have profound technological advancements, you increase productivity. And when you increase productivity, you increase profitability. And we're in that cycle already. I mean, investors were questioning whether or not all this CapEx was going to return anything, if there was going to be a ROI, return on investment for companies. Well, NVIDIA just told you yes.
Marianne, welcome to Excess Returns.
Oh, thank you so much for having me.
We're really looking forward to this discussion with you today. You are Chief Investment Strategist at Sanctuary Wealth, where you help guide the firm's advisors with your market insights and sort of big picture perspective on things. And just yesterday, Sanctuary released a pretty massive piece of work. I was fortunate enough to get this, and it's your 2026 year ahead outlook, where you talk about the markets, where you're seeing opportunity, where there might be some risks, and sort of get your perspective all in this, great report. And there are tons of visuals and charts that we're going to pull into this episode. So if you are listening on audio, you might want to pop over to either our YouTube channel or Spotify, because Marianne's going to walk us through a lot of this stuff today. We are excited to be joined by our friend, Al Green. Al is founding partner at Green Wealth Management Group here in Connecticut. Al actually played a big role in helping arrange this interview with Marianne. So Al, really appreciate you making that happen and this happen, and helping me with this discussion today.
Yeah, super excited to be here, Justin. Always looking forward to hear what Marianne has to say.
So Marianne, let's sort of start with, I guess, the big picture view, the long-term view. And that is in the report, you sort of start out by looking at the S&P and looking at, where you think the S&P could be by the end of the decade. And I think you have, a range of between 10,000 to 13,000 by the end of the decade. So just talk through, and I think a lot of this discussion will kind of get into the underneath the surface, why you're sort of making this call, but sort of at a high level, like what gives you the confidence in that sort of long-term market outlook?
So we've had this call now for a few years. So the secular target is not a new target for us. Equity markets tend to have bull and bear cycles, and they're secular in nature, meaning they're very longer term, 15 to 20 years. And we're in a secular bull market. So what does that mean? What is a secular bull market? A secular bull market is when you come out of a major secular bear market. So we were in a secular bear market from 2000 until 2013. The market tried to make a new high in 2007 and could not launch. And we did not launch and cleared that 2000 high until 2013. For the NASDAQ, that was 2017. Once you breach that trading range of a secular bear market, you're in a whole new cycle, which is a secular bull market. And so we've been in a secular bull market for quite some time. And since they average about 15 or 20 years, and then based on technical analysis, I've estimated that the cycle will end somewhere towards 2029, 2030. And then we'll enter a secular bear market where we go into a holding pattern for 15 to 20 years. And we've been doing this for decades. This is not new. This is a cycle that we've had for quite some time. Most people call a secular bear market like a lost decade, but it's normally more than a decade.
It's amazing how strong equity returns can be coming off of like a lost decade like we had from 2000 to 2009, basically. One of the charts you have, which I think is really just, it's striking, you kind of overlay different periods of time in the market. So the 1920s, the 1990s, and then you overlay the NASDAQ 100's returns on top of that. And I'll sort of just let you speak to this chart and what it's actually showing here.
Sure. So, well, Alan can attest that I've been calling for a bubble for a while. And why have I been calling for a bubble? Based on the patterns that I've seen primarily in technology or in the Russell 1000 growth index. There's been massive bases built over many, many years and sometimes even decades that's going to allow this market or this particular part of the market to go significantly higher to the point where it becomes bubblicious. And to kind of illustrate what I mean by a bubble, I went back and studied the two most famous bubbles, the one from the 1920s where we peaked in 29 and the dot-com where we peaked in 2000. So we've taken the NASDAQ, and I've used the NASDAQ because that's where most of the tech names are relative to the S&P, and overlaid the cycle from the 20s and from the dot-com. And to be quite honest, the pattern is staggering, how we're following that pattern. And if this is correct, it means we're in the early stages of entering a bubble. And Justin, what I can tell you is when people are like questioning whether or not you're in a bubble, it means you're not in a bubble, because most people don't realize when they're in a bubble.
Right. So in the report, you quote Sir John Templeton's sort of framework, like bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. So where are you placing us in the mature on optimism bucket right now?
So remember, Sir John Templeton is famous for diversifying his portfolio outside of the United States. He was one of the first famous investors that gained great performance from not investing, really having a significant portion of his portfolio outside of the United States. And the definitions that you just talked about really pattern a secular bull market. You begin a secular bull market on pessimism. No one sees it. I can tell you I was a technician at Merrill Lynch after the dot-com. And I started becoming bullish around 2001, 2002. I thought the markets had bottomed. And Justin, I couldn't give a stock away. That's a clear sign that you've reached a bottom. That's true pessimism. And then the market starts, accepting the fact that maybe we're moving, but they become very skeptical. And markets will keep moving on skepticism. Then the market they become more optimistic. Okay, maybe there's really something here. And then there's euphoria where they see nothing wrong. I think we're between skepticism and optimism, and I might have to lean a little bit more towards skepticism because we are talking about, are we in a bubble? There's a lot of skeptics. There are people now questioning the accounting methods of semiconductor companies, and is NVIDIA doing the appropriate? That's skepticism. And markets don't die on skepticism; they die on euphoria. So that also gives me very high confidence that we still have a lot of room in the secular bull market. So I still think we have at least another 4 years. And I might add, the end of the decade can have substantial gains. If you look at just like the last 1 or 2 years of, 29, 28 going into 29 and 1999 and peaking in 2000 had extraordinary gains, superior gains. So just because you might be going into a bubble is not a reason not to be invested. But I think diversification and knowing how you're positioned becomes much more important in a portfolio.
How are you thinking about 2026? We're getting a little bit more short-term oriented here, but I think in the report you were saying that next year could be sort of a year of the reset. So how are you sort of squaring those two things, like this, long-term outlook with maybe some choppiness or resetness in 2026?
Well, we have to remember, we had a bear market in 22. We had a major low. By the way, everybody was skeptical around that time. And the market is up like 100%. And that's just on the S&P. Part of technology is up, 200 plus percent, or even more. And markets don't go up in a straight line forever. And we're entering the midterm election year next year. And, the presidential cycle is very interesting. Normally, the first year of a president, markets do extraordinarily well because the president wants to put forth positive policy and gain popularity, right? The second year, they have room to do unpopular things. I'm not saying that Trump necessarily is following this order, because I would say tariffs were not very popular, but eventually wound up being okay. But if you're going to institute policies that are not popular, the second year tends to be the period to do it. And then by the third year, you either want to get reelected or you want your party reelected, so you stimulate the economy. And markets tend to do very well in the third year of the presidency, and then also continue to do well in the fourth year, but the third year is the strongest. I think we can follow the midterm election year. And in the midterm election year, it's really rough and bumpy. You're up and down in the first quarter, but from April through September, markets tend to be down and then tend to find their footing around September and rally into year end with an average return of 6%. My year-end target is 7,500, which is probably around that 6%, depending on when I wrote the report, it was around 6%. We'll have to wait and see where we end up for the year. But I'm having a hard time getting the markets up. I think there's a few things that can happen. One, earnings have been spectacular. You have to remember, coming into the year, analysts had maybe a 7% forecast for the S&P for earnings to be up, and earnings are up 15%. There's been 4 quarters in a row of double-digit earnings growth. And when you look at the growth in earnings, and I do have a chart of that, it's kind of going parabolic, which means the comps for next year are going to be challenging. So I'm not saying earnings are going to be down next year, but the rate of growth for earnings is going to be really hard to beat. And markets trade on the rate of change of things. So if earnings can't continuously beat on a very high scale, that's going to be a problem for the markets. Another problem that I see is there's 2 stories to interest rates. Interest rates on the very short term, I think, are at risk of rising. Why? Going into the end of the year, businesses need to close their books, and there's high demand for capital. And when you have high demand for capital, interest rates tend to rise. And that seasonality tends to also go over into the first quarter. So I do see that although the Fed wants to lower rates, maybe, because now we're going back and forth, is the Fed going to cut rates? I do think there's a short-term risk of rates rising. And this is both on the 2-year and the 10-year. But longer term, they're clearly peaking and falling. But the market's not positioned. If interest rates wind up rising, the market is not positioned for that. Not on the equity side, not on the fixed income side. So again, you get a lot of choppiness, right? This reset, this consolidation. So I see consolidation probably more so in the first half of the year for equities and fixed income, and getting that reset, and then things carrying forward where interest rates can go down and equity markets can continue to rally.
That makes sense. What do you think about valuations? Like in the piece, you highlighted that, if you look at the forward PE, almost any valuation measure, the market looks kind of expensive here. How concerned are you about valuations? And then how do you think valuations can best be utilized by investors?
So what investors really need to understand is valuations are just a metric of a point in time of where value is. I've spent a lot of my career testing indicators, and other people in the industry have done the same thing, and we all say the same thing. PE is not a timing tool, doesn't forecast the direction of markets. But valuation, when you're at high valuations, you can't have things go wrong, right? Because things are expensive. So I think there's 2 stories to valuations. First of all, the markets have recently pulled back, depending on the S&P is down about 5.5%, NASDAQ's down about 8%. So some of those valuations are not at peaks anymore. We've come off a little bit. Because valuations are high, I see risk of interest rates going up. I see risk of not being able to maybe continuously beat earnings expectations. Valuations are going to play a role in that you're not going to be able to sustain that high PE. But I also think there's another story in terms of the secular trend. When we study secular trends in markets, PE multiples tend to expand. And I do believe in time, when we get more towards optimism and euphoria, you're going to see multiples expand and hit new highs, possibly even surpassing the highs that we saw in 2000. So I think there's a short-term story to PEs and a longer-term story. One where right now I don't think the market is emotionally positioned for valuations to be this high. But later on, as we become more optimistic and we move into euphoria, we will allow that multiple to expand. I think we also have to understand where we stand in the market is nothing like the 1990s, where companies didn't have, a good balance sheet, good earnings. The companies that are really driving this in the tech space are actually mature companies, which is kind of unusual. These are not new companies. They've been around, they're mature, they have mature balance sheets, and they're generating a lot of cash flow. So I think that's a longer term positive.
Yeah, one of the, I think, really interesting charts you have in here is this one that shows kind of like valuations have been, I think this is what this chart is showing, right? Valuations have been more so trending like upward, like the upward trend in valuations. You have this chart going back to the 1900, but if you look at the last like 20 to 30 years, valuations generally have been trending higher.
They have. There was a period of time where basically prior to the 1980s, where PEs traded in a perfect cycle. You reached a certain high and then you came down and you went basically sometimes 10 or lower single digits. When we had the great financial crisis, the Fed didn't allow PEs to go into that 10 or single digits. I think if you continue to have bank failures, we would have seen that 8%, but that was taken off the table. When you look at the secular bull market from the 1980s to the peak of 2000, PE multiples expanded in a channel. And since the lows that we set during the great financial crisis, we are tracking not exactly the same, but we're tracking in an upward biased band. And when the valuation gets to the lower band, the valuation goes right back up again. So I think we're repeating that secular trend that we saw from the 80s to 2000, where PE multiples will expand.
Your theme, all that's new is old, argues that today's AI revolution follows historical patterns of technological innovation. And you're showing on your chart that railroads in the 1830s, the internet in the 1990s. Can you walk us through how you see this playing out going forward?
Sure. So in the report, we kind of went back and looked at different points in time when the economy had a major innovation, and railroads was a very significant innovation. Every time we had a major significant innovation that really revolutionized the economy, GDP growth soared. You went from around 2% GDP growth up to 4 or 5% GDP growth. So when we have these major innovations and have our economy grow, it's normally based on one innovation. Like, for example, railroads. Today, or you had the computers and you had the Internet World Wide Web. But, the Internet World Wide Web is kind of the same story. When you have profound technological advancements, you increase productivity. And when you increase productivity, you increase profitability. And we're in that cycle already. I mean, investors were questioning whether or not all this CapEx was going to return anything, if there was going to be a ROI, return on investment for companies. Well, NVIDIA just told you yes, right? The earnings this year are telling you that all this CapEx spend is already turning into profits. And when we look at productivity, we're already starting to get a spike up in productivity. Productivity is already growing. And when you look back, at least during the dot-com, on a quarter-to-quarter basis, there are times productivity rises to 5, 6, 7, 8%, quarter to quarter. So I still think we're in this very early cycle of bringing new innovation to the economy that will grow GDP in the United States. And I think eventually you're going to see the U.S. growing its economy around 4%. That's going to be profound for profits. So although I think next year is a challenging year, and that's why I titled my report Be Fearless, you've got to stay steady and stay invested, or have some dry powder, as things pull back, to add to exposure. that the runaway that we have between 2026 going into the end of the decade is really long and very powerful to the upside.
You talked about AI-driven capital expenditures, and this, I feel like it's been in the news every day, particularly the mechanisms for financing those. But what you're saying is that you do see productivity ultimately leading to corporate profit growth. Is that just in technology, or is that everywhere?
Eventually, it'll happen across industry, because if companies do not adopt the efficiencies of AI, they risk going out of business, right? And again, this is when we studied technologies, you know, the innovation plays out over many, many years. It's not just 1 year, 2 years. This plays out over time. This is going to happen probably over the next 5 to 10 years. And one of the bigger themes that I talk about, but I don't talk about it in this report, but Alan can tell you I've been talking about this, to help people to understand what's happening with our economy. We went back to 1500, not that I remember it, and looked at what was the main driver of that economy and what was the technology. Well, in the 1500s, it was agriculture and it was the sundial, right? Knowing that sun for agriculture was really important. So that sundial was very important to farmers. Our economy didn't make a major transformation until we created the steam engine in the 1700s. And from the 1700s going into the 1990s, 2000 period really was what driving our economy. But as we brought computers, it developed the internet and the World Wide Web, we became digital. Our economy is now driven on digital technology, and we're going to continue to have layer upon layer of new advances in technology. So the World Wide Web is one, and now we're putting AI on top of that. You know, there's blockchain, and something else maybe in the next 10 years will come, and that's quantum computing.
Yeah.
Right? And then something will come after that. That for the next 100 years, our economy will continue to advance based on the upgrades of digitization.
So how about, can you speak a little to market concentration and where we are in history? A lot of people are worried that it's a risk, and others are noting that these large companies are very profitable. How do you think about that, Marianne?
So the structure of the equity market has drastically changed. The supply and demand dynamics have changed. Why? When I first came to Wall Street, and that's quite a while ago, we had over 5,000 stocks listed on the New York Stock Exchange. That's like 2,300 today. There's been a dramatic decline in the amount of companies available in the public market, right? While net worth has risen, and the funds available to go into the public markets has risen. So just based on supply and demand alone, prices should go up. That's plain, economics. And I think that's why the private markets have grown so much, right? Because more and more companies are staying in the private market and not going public. And now we're just starting to see products become available so individual investors can actually get access to these companies, because they can't get access in the public markets. So everybody likes to point out to the Nifty 50 back in the 1970s, that they peaked at the end of that cycle. You had a concentration in the Nifty 50. Again, that's not an indicator. It's just a moment in time. And I like that we have such concentration in the market. Not really. I don't like it. I don't like that NVIDIA is like 7% of an index, because it is concentrated, but this is where we are. And what people don't understand, it's not just the index, it's the sectors. You go out to every sector, and there's a couple of companies driving that sector. If I go to consumer discretionary, 40% of that sector is Amazon and Tesla, right? So the whole structure of the market has dramatically changed. So does that mean that has to signal a peak in the market? No, it's just saying that the structure has changed. Risk in a portfolio has changed, and you have to be mindful of that risk in a portfolio. Alan, that's why they need you to help manage the risk in their portfolio.
Speaking of risk, you've noted that equity market corrections are happening much more frequently, with 4 bear markets in the past 8 years, twice the historical rate. They also seem to be resolving themselves a little bit more quickly. Do you have any thoughts on why that's happening?
Gee, Alan, I have a lot of thoughts on
All
that.
right.
Isn't that surprising? So again, the structure of the markets have changed. They're very technologically based, and there's traders that have programs that are now reading every word that comes out and will trade on just a word. And that happens like in less than seconds, that like milliseconds. And so I do think that having algorithms, they're called algorithms, trading the market have changed the behavior of markets. Does it change the long-term direction of markets, or does it change the long-term direction of a stock? No, because markets still trade on fundamentals. But what's happening is we react a lot faster. And historically, when I came into the markets, we had a bear market, meaning a 20 or 30% pullback every 4 years. Now we're getting a 20 or 30% pullback more often. As you pointed out, we've had 4 bear markets, meaning at least 20% down. And then we resolve them very, very quickly. That's more volatility. No wonder clients are nervous about markets. To watch your portfolio go down 20 or 30% is very unnerving, particularly if you're in retirement or going very, you're close to retiring, because you don't want to lose those assets. And I think this is going to continue. We're going to continue to have extreme volatility. A word that I use in the report is episodic volatility. But that doesn't mean that we can't reverse and go higher. And that's why I talk about a secular bull market. What happens in a secular bull market is you will have bear markets, but they resolve themselves and go on to all-time new highs. In secular bear markets, they will go down, but they don't go back to all-time new highs and sustain all-time new highs. It's a very different behavior. So I think it is important to know that you are in a secular bull market when these bear markets happen.
Do you have any thoughts on this question about value versus growth stocks? And because it's been a long, growth has been outperforming value for maybe like 15 years at this point. And a lot of, systematic value investors have been pounding the table that now's the time for value stocks. And yet the growth is still, outperformed. So where do you kind of fall within the growth value debate?
So we have a great chart of that. And if you look at the chart, there's this saucer base. In technical analysis, it is called a saucer. My aunt, who trained me, always called it a smile. And when you see a smile, it's bullish, right? That's easy to remember. And we've broken out of that base, and it's quite a substantial base. And there we came down and we tested it pretty violently. And we've rallied, we've consolidated again, and we've broke out. And I think we're just in another consolidation phase. When you look at where the earnings power is coming from, it's coming from technology, it's coming from communication services. We have seen an uptick in financials have had some good earnings and pockets of healthcare, but the real strong earnings remain in tech and tech-related names, and that's powering growth. And I think growth companies are scarce. What do I mean by that? If you go around the world and look at what companies are developing AI, are developing robotics, are developing blockchain, the majority of the companies are here in the United States, which means global portfolio managers have to own growth here. I think value's outside of the United States. Now, because I'm looking for this reset, I think value can temporarily outperform, but I don't think it's taking over leadership. That's sectors like financials, healthcare, energy. The pocket that I really like in value would be more of the financials and the banks. But I don't see healthcare taking over leadership. I don't see energy taking over leadership, particularly with an administration that's trying to keep oil prices down. It's going to be hard for energy stocks to be leaders. And this is where the bubble is. This is the bubble, but it hasn't really become bubblicious yet because we're not in euphoria. And again, we'll take you back to the chart of looking at the 20s and the 1990s. I do think growth will become bubblicious, but we're not there yet.
You called this like 10 years ago when we were both at Merrill. And I remember you talked about the indexes and what index to own. And you were all over the NASDAQ. And at that point in time, you also talked about defense stocks, which have recently done well again. So I just want to give you some kudos for that call a long time ago.
Thank you. I appreciate that. Yes, I've always called the NASDAQ the digital index. I think that should be called digital index because it houses most of the digital companies.
Well, and I also know, Al, to your point, that Marianne's been, largely right with a lot of these, macro and market calls. And, it's easy to kind of pile in on the bearish side of things when the market's weak, but, kind of staying, positive and constructive has been the right call for sure over the last 10 to 15 years.
What investors have to understand, the time to buy is when the news is bad. And that's very hard for investors to do. That's why it's very important to have a financial advisor to help walk you through the volatile times. I'm sure, Alan, you find when you're in a bull market, clients don't necessarily call you as much, but when things start going upside down, your phone starts ringing off the hook.
It's only taken a couple days, and I noticed the call volume has gone up.
Yeah, that's a sign that things might be maybe turning here for the positive. But let's talk about international markets. So it's been a pretty dominant U.S. dominated market environment for a number of years up until this year, I would say. What is your current sort of view on international stocks, and do you think the recent outperformance of international has got some legs here?
So basically for my entire career, which spans 40 years, it was an either or call. You either owned international or you didn't own international. And because the US market has done so well, basically just investing in the United States has been the right thing to do. And you haven't needed to really look overseas. But something has dramatically shifted, in my view. It now looks like non-US markets are now in a new secular bull market. And I've never seen this before, where the US is in a secular bull market and non-US markets are in the secular bull market. But they're in different time frames, where the US is in the latter stages of a secular bull market and non-US equity markets are now in the early stages of a secular bull market, meaning those markets have the ability to outperform over the next decade, maybe even 15 years. Do I believe that, the non-US markets will outperform the US every year? Not necessarily. If interest rates wind up rising, I think the dollar is basing. People gave up on the dollar. I think the dollar is actually a very strong currency. It bottomed in 2008 during the great financial crisis and actually has been in an uptrend. But the media would make you think that, the dollar is falling out of bed and that we're going to lose our reserve status. I don't see that happening. And if interest rates go up, the dollar is going to go up. And when the dollar goes up, you lose part of the return from overseas due to currency translation. But I don't think that's a reason not to start building positions in overseas markets. And it's staggering how many of the markets are in a secular bull market. The first one I'll talk about is Japan, which was in a bear market, secular bear market for 35 years. Can you imagine that, being in a bear market for 35 years? And why did Japan break out? Because they now have corporate governance. They're managing companies now for profit, for earnings, and they're trying to have growth policies for their economy. And the Japanese yen, at least relative to the dollar and some other currencies, is weak. Why? It allows them to export. And I think Japan is going to become, they've always been exporters, but I think they're going to become a massive exporters, and that's going to help drive profits for exporting companies. When you look at Europe has just gone into a secular bull market. And when we look at emerging markets, ex-China, they've gone into a secular bull market. China is still in a secular bear market, but their tech companies are trading very well. But I think what's holding back China is they have very strong deflationary forces still taking place because of the real estate bubble popping there. So I think their economy is still struggling. They also, due to the one-child policy, which is not in play anymore, but in years past, their population growth is shrinking. So their demographic story and the overhang of the real estate, I think, is holding back China. But there's a lot going on outside of the United States where I think investors can start tiptoeing. And if I could just add one more thing, our secular bull market will end. And what I'm seeing in the international markets is telling me that's the new leadership in the next decade. So from 1930 to or from 2030 to 2040, part of the new leadership will come from outside of the United States.
And this other chart here that shows the correlation of these main international markets relative to the U.S. And it looks like, over the last 5 years, that correlation has actually been falling. And what's also interesting, I'm interested in your thoughts, this year's a good year for international, and you're making a good, strong case for international. And it's interesting with this, deglobalization happening around the world, and countries and economies now have to kind of rebalance themselves. And so, what are your thoughts on sort of that in terms of the international opportunity?
So with the correlations coming down is classic benefit to portfolio diversification, that they are, or they should add diversification over time. And I want investors to think this is not just a 1 or 2 year event. This is over the next decade, where I think international is going to add exposure or add a positive return and diversification to a portfolio. And to your point, the big change is with President Trump convincing NATO to help with defense spending. And Germany has committed 500 billion euro over the next 10 years to build out defense. And now they're even talking about, can the UK join that part of the Europe defense fund? So you're going to see government stimulus that will help an economy. Just look at the US. Anytime the government spends money, what happens to risk assets? They go up. And we're now seeing this for Europe. And this is a significant change because they tend not to like debt. They tend not to spend. And to have this massive amount of spending should really benefit the economy. And when you benefit the economy, you benefit corporate profits. And again, when we look at valuation, valuations are much cheaper. So you're getting, if you want to add value to a portfolio, I think that the value is outside of the United States, not within the United States.
When I saw you present a month ago to Al's firm and his clients, you had an interesting take on inflation. You had sort of like a short-term view of inflation, and then you had a longer-term view. Can you explain? I don't know if it's changed at all from, it was only a couple of weeks ago. Maybe it has, but if it hasn't, can you explain what you were thinking there?
So when I was talking to you, the short of it is, I think interest rates are going to go down, and can go down to extraordinarily low levels, like 2.5%, possibly even lower, with inflation over time coming down. But that the secular cycle for inflation has already started. We have inflation. And we know we have inflation because the Fed's target for inflation is 2%. We're at 3%. And they haven't hit that 2% in 4 years. In this report, though, because some things have changed since I did that presentation, some more data has come out. There's an index that comes out. There's 2 of them, ISM manufacturing and ISM services. And there's various different indices in there, but one of them is prices paid. And when you look at prices paid under both of these, they've gone up a lot since just like a couple of months ago. And I overlaid CPI. And it's not a direct correlation, but generally when you see an increase in these prices, you get an increase in CPI. So my concern is that we may not have seen all the pricing pressure from tariffs. That's a concern that I do have. And I find it ironic that the BLS today said that they're not going to report October CPI numbers. So the Fed is not going to have CPI data when they meet in December.
Is there anything in the private credit market, which has become much larger part of our lending market, is there anything that sort of you see that has you at all concerned? Any of that?
No. And I'll tell you why. Not that I'm an expert. I am not an expert on the private markets. But our banking system is the best I've ever seen in my entire career. Their balance sheets, because of the great financial crisis, because of Dodd-Frank, are sitting in very, very good position. And this is not a direct example, but I want to give an example where we had a finance event that had pressure in the industry, but we were able to move past it. And that was during the dot-com bubble. In 1998, Russia defaulted on its debt. And we had a hedge fund called Long-Term Capital that was very leveraged to that. And there were banks, and one particular bank that was very exposed to them. And we had financial disturbances in the system. And the Fed came in, cut interest rates. Back then, we didn't do quantitative easing, but they can, print money, provide lending facilities. And Warren Buffett came in. And within 1998, markets went down 20% and then closed up 20%. So the question we have to ask ourselves is if there is a holding that a private credit company has that is going under, what financial instability does that create in the system? And it doesn't create instability in the system. It creates instability for that company. And you may have a temporary negative reaction. People panic, may sell risk assets. But then if you don't have an underlying major instability in the financial system, then things are fine. Now, the Fed might come in and cut rates, might create lending. Now, here's another example. A couple of years ago, up in Silicon Valley, we had a couple of banks go under, and that was kind of like a little crypto event. And that created instability in risk assets. And then all of a sudden, we moved past it, and we were at record all-time highs. So really, when I look at the private markets, I'm not concerned about it creating an instability within our financial system. And that is when you have a problem. And the other thing is, investors always go back to the last crisis they know. And the last crisis they know is a banking crisis of the great financial crisis. And it's a psychology thing. And we're nothing like the great financial crisis. The banks are completely changed and altered. So although you may have temporary instability because maybe something within a credit portfolio defaults, you'll create this volatility, but I don't think it breaks the system.
Yeah, that recency bias is really something, isn't it?
It's extremely, extremely something.
So one of the things you've been talking a lot about, one of the top performing asset classes this year has been gold, and up about 50% for the year. And you're still bullish, but you expect a little bit of a consolidation early in 2026. Tell us your thoughts.
Yeah, so gold is the best performing asset. And my target for gold in my year ahead last year was 4,000, but I'm going to be honest, I didn't think we'd hit it this year. I mean, I did think we'd get to 4,000, but I didn't think it would be this year. Is everything that could go right for gold did go right for gold this year. We do have inflation. This doesn't get talked enough about. Gold goes up during inflationary periods. We have inflation. It's not hyperinflation, but we have inflation. So gold goes up. When interest rates go down, gold goes up because cost of carry goes down. We've been in a lower interest rate environment. Central banks around the world, particularly emerging market central banks, wanted to diversify their assets, and they wanted to diversify in gold. Everybody talks about China, and they are diversifying, but there's also other emerging market central banks that are diversifying into gold. And then whenever you have geopolitical risk or concerns or worried, gold tends to be a beneficiary, and we've had that. I mean, it's been an amazing year for gold. But because, again, it's gone up so much, we can get a consolidation. If interest rates do go up temporarily, again, I said gold doesn't like higher rates, you can get a consolidation. But my target for gold going forward is 5,000, so I'm a buyer on pullbacks. And let me say this. This is really important in portfolios. If you're an investor and you are concerned about inflation, one of the best inflation hedges, assets to have in a portfolio is gold. So I do think gold now plays a very important role as an asset in a portfolio.
One of the most recent new clients that came in had 55% large cap technology stocks in his portfolio. And you're emphasizing diversification in 2026. What would someone like that look to diversify?
So that's quite a concentration. That's a lot of concentration risk. That client, though, has probably made a lot of money, right? So when you look at that, right, because a lot of people don't think about this, it's easy to tell somebody to sell it and diversify it, but what are the tax consequences? And can they handle those tax consequences? So it's really important to work with an advisor to diversify a portfolio so you can do it efficiently. But if I was to diversify, again, I like the international markets. I like diversifying into some gold. We haven't talked about crypto, but I'm assuming if this client has 55% in technology that they're a risk player. If you can handle a lot of risk, I think you can diversify outside into the crypto space, which has just had a massive correction. And I think is trying to play ahead of a 4-year cycle where Bitcoin tends to go down. So I think part of that correction has already happened. But again, crypto is highly volatile. But I do think that asset class is here, but it's not gold. We call it gold, but it's not gold. It's a digital form. I believe we're moving to a digital platform, that there'll be a day where we have no coins or paper money. And you're already starting to see that happen because now we stopped printing pennies, and I think the next one is nickels. So I think we need to understand that digitization of money is changing. And how do we put that into a portfolio and benefit? And you can go into the private markets. I don't think we've reached a peak in investing in private markets. I think you have to do more homework. I think you have to be more selective, but I do see opportunities in the private markets. And what's really interesting, Justin, I don't know the age group of your listeners and viewers, but when younger people are asked, what do they want in a portfolio? They don't think they're going to get the same returns as their parents in just stocks and bonds. They're willing to take more risk, and they can because they're younger. And they want to go into crypto, and they want to go into the private markets. And again, I think the amount of time you have left to retirement allows you to take more risk, right? Somebody closer to retirement, maybe the risk profile is shortening up. But a young person should take a lot of risk in a portfolio because they have a lot of time to ride out even secular bear markets. So I think investing today is a lot different than what it was. Justin, when I came in the business, the rule of thumb was your bond exposure was 100 minus your age. And that rule doesn't work anymore.
No, that one's a little tough these days. So you're talking in your report about several key risks for next year, whether it's inflation coming back, the fiscal deficit, slowing earnings growth, unemployment, geopolitics. Which one of those keeps you up at night?
Inflation. I do think, the Fed has a tough job managing employment and inflation. And they've got a problem now on both sides. And they have to pick a side. And obviously, they're getting a lot of pressure to pick the employment side. And what we have to remember is the Fed cut 100 basis points last year. That's already entering the system. It takes 12 to 18 months for monetary policy to actually enter into the system, into our economy. So you're getting that 100 basis points from last year just coming into our economy. The Fed just cut another 50. That's going to hit us next year. So you know, today was kind of an interesting day because the New York Fed president was of the opinion that they can err on the side of labor and possibly cut another 25 basis points. And the market loved it. The market ripped. I don't know if we're still ripped, but we were ripping today just based on that comment. The market clearly wants lower rates. You can also see that in the 2-year Treasury yield pattern, where I think you're going to see rates down eventually around 2.5. Now, inflation may be temporary, right, due to the tariffs, but we may possibly at some point have a print that the market doesn't expect on inflation. So I do see that as a risk going forward.
We have 2 standard closing questions. Before I ask those, what I want to say is that we've just really scratched the surface of everything that is in this report. And Marian, I don't know, will this eventually make it to the Sanctuary Wealth Insights? Will this eventually be posted online?
No.
No. Okay. So
Yeah,
this is,
that's
this
kind
is
of just for just
this is
internal
just for
use.
us. Yeah,
You may
gotcha.
get snippets. I did do a webinar with Sue Herrera yesterday, the anchor at large at CNBC. Sue and I have
Okay.
known each other for decades.
Yep.
And we're in discussions of putting out some shorts. So you may get snippets
Yeah.
of the report. And of course, you've got a lot of snippets here. Your view has just got a lot of snippets.
Yeah, this is great. So thank you. We can might have to have you on again to go through the rest of it, but really appreciate it. So the 2 standard closing questions we have. The first one is, what is one thing you believe about investing that most of your peers would disagree with you on?
When I saw that question, and I'm glad I saw that before I came on because I really gave that some deep thought. I'm old school. I was trained old school. My aunt trained me, right? And she came into the markets in 1956. She was a trailblazer. She was the first woman trader at Ladenburg Thalmann. Of course, she didn't start as a trader. She started as a secretary. And back in those days, Warren Buffett days, you bought blue chip companies and you held them and you collected dividends. And I still believe in that strategy. I believe that can fit in a portfolio. It may not fit every client, but I still believe in that strategy where you should own good companies and collect a dividend. And if you can, reinvest that dividend. Now, baby boomers, retirees may want to have that cash flow, right? And over time get appreciation. But it's a great way of compounding your returns over time. The market has become so focused on products, ETFs, for a form of investing. And I am not against ETFs. I am all for ETF investing. And I'm not against products. But I do believe you can have a portion of your portfolio invested in blue chip companies.
And then the last question for you is, based on your experience in the markets, what's the one lesson you would teach your average investor?
Compound investing. The younger generation does not understand the power of compound investing, and that you have to start saving as soon as you start working. I have heard many stories where young people don't believe investing and are not investing in their 401k plans. And even when companies are matching, I think that makes my skin crawl. True story. I have some very dear friends that did not save and are really struggling today. And when I tell you they're penniless, they're penniless. They're scrapping just to live. And that breaks my heart. I don't want to have anyone ever have to live in that fear and that worry. Can they pay the rent? Can they pay the food? We have too many people in the world today that are living in fear of paying rent and just buying food. And if you can work, save, have a retirement program, put that money in, and never, ever, ever touch it. Too many people touch it. And if you are able to do that, then when you retire, you can retire comfortably. And Alan, do you have anything to say? You see a lot.
Yeah, I think that's a great piece of advice. Often people, I call it above the line savings, but just start saving before it hits your checkbook so you can't spend the money.
Marianne, thank you very much. This has been a great conversation. And Al, thank you.
Always a pleasure. Thanks, Justin.
Thank you both for having me. This has really been a pleasure.
Happy Thanksgiving.
Happy Thanksgiving, everyone.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.